Okay, I think we can begin. Hello, everyone. Thanks for joining. I'm Hadass from the Popular Investor team. I'm really glad to have Wesley here with us to share his quarterly update. And just, a general note, you can feel free to put your cameras on, everyone. Keep yourself muted, please, but we'll be happy to also see your faces. So you can feel free to turn your cameras on. Wes, on to you.
All right, cool. I'm sorry if there's a little bit of background noise. It's quite hot in London, especially in the room that I'm in. So there's a fan on me and I've got the windows open. If it gets very bad, just let me know. So welcome to my Q3 quarterly call. I realized that Etoro calls it the Q3 call and I call it the Q2 call. I'm always one Q behind. And that's because I'm using it to review what happened in the last quarter, but technically it's happening in Q3. So there might be some Q2s and Q3s misplaced in the deck. Sorry about that if it happens. So you're here for the quarterly update. I'm going to talk through the topics on the right on the call today. I think the call is scheduled for 45 minutes. And I think we should have time for Q&A at the end, hopefully 5-10 minutes of Q&A. If you have any questions whilst I'm speaking, if you want to pop them into the chat, then I'll start going through them right at the end. I'll start today by talking about my personal background, my investment journey, my investment strategy, my lifetime goal as an investor, the key events for Q2, the quarter that's just gone, performance review for that same quarter, the winners and losers in asset classes and various other areas within the economy for that quarter, and the portfolio changes that I made during Q2. I will also spend a bit of time looking forwards towards what I think will happen in the second half of this year, the second half that we've just started, at a fairly high level. And then I'll move on to closing remarks and then Q&A. Okay, so in terms of my background, I am an immigrant. Immigrants don't get a very good name these days, but I'm an immigrant from South Africa. I moved to the UK. It's quite a long time now, 13 years ago. So I grew up in South Africa for the first 28 years of my life. I've realized that I've actually spent longer than 20 years as a consultant and entrepreneur. So I've typically worked in technology consulting since I was a teenager. That's how I made money. I didn't really work as a waiter or do those usual jobs. And I've worked in just about every sphere of technology, from hardware to software to cloud computing, et cetera, et cetera. And I've built a few different companies, or I've been a partner in a few different companies from the beginning of, I'd say, roughly 5 companies. I'm a published author, so I wrote the first book on Salesforce technology. That was a long time ago, in 2011. I know Salesforce quite well. I have the highest level of certification in Salesforce technology. And the largest company that I've ever built was Europe's largest Salesforce consulting firm that was bought by Accenture in 2015. And then subsequently I worked for Accenture for 2 or 3 years as a director level consultant. So I've had the opportunity to work for some of the world's largest companies up to an executive level. For example, I've worked inside of Unilever for many years. And the largest project that I worked on was at a value of more than $100 million across many, many countries. And I've also worked in very small, young startups, building them myself or working with startup founders and in the hopes of being successful. And I've worked with all the companies in between. So I've seen inside a lot of different business models. I've seen a lot of different approaches to building businesses, different styles of leadership, what helps companies be successful, what gets in the way of success. And that's ultimately a key element of my investment style. I am a full-time Etoro popular investor, and I have been since late February of last year. In terms of my investment journey, so I started investing in 1999. straight out of high school, I was a bit naughty. I didn't go to university immediately. I was tired of studying stuff, and so started working immediately. And during the 99 boom, there was a dot-com boom in South Africa too. But being young and inexperienced, I just picked the name, the most successful tech company in South Africa, the one that had run up the most in value over the past 5 years or so. And over the next 2 weeks after investing in the company, I saw my investment decline by, I think, 75%, 80% over that 2-week period. And that was the first time burning my fingers, becoming a little bit curious about how the stock markets and other asset markets work. I am self-educated, so I come from quite a poor background where financial education isn't very high on the priority list. Everyone's just trying to get some food in their bellies, make sure they've got a roof over their heads. So I spent a lot of time from 99 onwards teaching myself about the various different assets. It was quite tricky to do because the internet was very young back then, so a lot of that stuff was in books and difficult to digest. And then started formalizing that knowledge through the 2010s. So found lots of mentors that I could work with and achieved the certification in 2 years ago, I think. I joined Etoro in 2015. I have used a number of different investment platforms over my investment career. In the UK, there were several tools to use, but when I used Etoro, it was immediately quite different. Using it is much simpler. It's a lot less scary to use. It also had a much wider asset class than most platforms had back then, and the social element was completely unique. That didn't really exist, at least not in a user-friendly way, on any of the other platforms. I spent some time figuring out how it worked, Etoro, and I did fairly well in my investments through 2015 and 16, which were quite tough years for parts of the market, and started drawing people's attention and became a popular investor in 2016. Outside of Etoro, I am a property investor, although that's becoming a little bit trickier now with rising interest rates. I'm also an angel investor, so I invest in quite a few very young companies, or very young to slightly mature companies. It's not apparent from my Etoro portfolio or from the things that I talk about when I make videos and write posts, but I've been a crypto investor for a very long time, since 2012, if I remember correctly. And I was so involved in crypto that I even was a miner. I used to mine Bitcoin, and then later on Dogecoin, but I sold all my Dogecoin, unfortunately, before it became very valuable. And I'm also a business advisor. So there are companies that I invest in that I advise, and then there are some other young companies where I work with them, just because it's something that I really enjoy. I love young, innovative businesses. In terms of my investment strategy, I find it's useful to break it down into these 4 pillars. So there's my investment style, which is long-term. So the vast bulk of my platform, I am invested for months and years in those various assets. I have a business owner mindset. I find this is very, very important. I think that a lot of people, especially new people to the market, they don't see the stock market exactly as a casino, but it's something where they would buy and sell assets without knowing necessarily very much about those assets. Maybe they spend a few minutes understanding those assets. And there's almost nothing in life that you would buy without spending some time researching it. I mean, if you're going to buy a fridge or a computer or a camera, you probably spend more time researching that. Well, lots of people spend more time researching that than they do the assets that they buy in the stock market. I spend quite a lot of time understanding the businesses that I own or potentially want to own in the future. Having owned businesses and worked with business owners, I know the things to look out for, and because you're taking ownership of these businesses, you own a share of this business, the share of the profits. You want to make sure that you understand exactly what those businesses are doing. Are they doing the right things or the wrong things? And there are lots of things that they can do right and lots of things that they can do incorrectly. So I spend a lot of time doing this, and where I can, I'll talk to people in the business too. The abbreviation there is GARP, growth at a reasonable price. And right now, when we're in the depths of a bear market, it's very easy to find a good deal. There are lots of stocks right now that are incredibly cheap. Maybe they get cheaper, but nonetheless, there are lots that are cheap right now. But 2 years from now, when the market has moved on, 3 years from now, when the market is roaring, 4 years when there's been a bull run for a while, it becomes a lot harder to find those very good, cheap deals. And that's when, and the market spends quite a lot of time in this place, right? Bear markets are typically a quarter the length of bull markets. So there's a lot of time when markets are running up in price. And then it's not about necessarily finding things that are dirt cheap, although it's nice to find them if they do appear. It's about finding companies that are good growth companies and high quality. So I don't mind owning them if they're not dirt cheap, if they've got demonstrable growth and their strategy shows that they're a good company. I prefer profitable growth over non-profitable growth. And this was a thing that was quite frustrating through 2020 and part of 2021. There were lots of rubbish companies. The share prices were just going absolutely nuts. Valuations did not matter at all. Some companies didn't even have revenue, right? They didn't have money in the bank. It's not about profitable at all. They weren't selling things, and their share prices, their market caps were in the billions. And that area of the stock market has been washed out quite a lot over the past 6 to 12 months. But I generally prefer, even if companies are high growth companies, I prefer that they have some profitability. And in the rare occasions when I buy a company that's not profitable, there is the promise of profitability in the near-term future. Not necessarily the management saying we're going to be profitable, but all of the other pieces of the puzzle show that this is a company that's growing margins, they're growing revenue, they're taking market share, and that it looks as though they're going to be profitable in the next few quarters. So Twilio is a company that I believe falls into this camp. It's a high growth company, fantastic, a leader in its sector, has had a lot of trouble becoming profitable over the years. But I think that they are probably 2 to 4 quarters away from it now. I tend to be US focused in my investments. The US market leads many of the other world markets. Although I'm not shy about buying good companies in other geographies. So some of them will be US listed, but they actually are operating in other regions. So Alibaba is listed in the US, Mercado Libre is listed in the US, but those are companies that operate primarily outside of the US. Then there's my analysis style. How do I look for and find the companies that I want to invest in, as well as dismiss the companies that I don't want to invest in? And this list is in priority order. So the higher up an item is in this list, the more important it is to my process. So I am first and foremost a bottom-up investor. And this means that fundamentals are the most important thing to me about a company. So even though macroeconomic conditions can drive the direction of a share price in the short term and the medium term, I will potentially consider that. But if the fundamentals are so good that the company is dirt cheap and fantastic in quality to me, the fundamentals get the priority in that case. In addition to this, like I've been harping on about, I need to understand the business model. How does this company make money? Is the company well run? Are they making enough profits? What's happening with margins? Who are their competitors? How good are their competitors? What's the size of the market? What is the market like? Are they able to take market share? Who is their leadership team? Do they have a proven track record within this business or within other businesses, et cetera, et cetera? So what is the company's strategy? What are their product lines? What's the product roadmap? All of these things make up the full picture. Looking at the numbers that you get in Seeking Alpha or whatever your tool of choice is not enough. You you need to understand what these companies do in order to know if they're going to be successful in the long term. I prefer to invest in growing industries, and this is a bit of a moving target, but it doesn't change very drastically. Some examples. Automobiles were not a growth industry for the past, let's say, 30, 40 years, up until 2 or 3 years ago. And then it changed. And now electric vehicles are a growth industry, and lots of companies have rushed into the space, and some of them are doing very well, and many of them will fail, and there'll be a huge consolidation. But if you find a good company in that growing industry, then you are increasing your probability of success, because investment is a probability game, a game of probabilities, where you're trying to swing the odds more and more into your favor. So another growth industry that I can see through the next, and this is much longer term, 1 to 2 decades, is copper. So a very large part of the world doesn't have electricity yet, and everything we do is demanding more and more copper. So copper it's kind of already there, but I think it's still at the beginning, the early days. It's another growth industry for the long term. So it's not always obvious what the growth industries are. It's not just the FANGs. It's not just streaming companies. Sometimes there are societal trends that create growth industries, but finding good companies in growing industries always increases your chances of being very successful. Macroeconomics is quite important to me, not always because of the investment decisions I make, but because a large part of investment is about psychology. And understanding the various elements of macroeconomics can give you some peace of mind, right? So we're in a bear market now, and the market has been declining depending on where you look at the market. So smaller companies have been declining since the first quarter of last year. Larger companies have been declining since the fourth quarter of last year. If you didn't have an understanding of interest rates, inflation, the credit cycle, the business cycle, the way central banks work, you wouldn't understand why the markets were experiencing the challenges that they have been at the moment. Or maybe you would at a headline level, but not enough to interpret the causes deeply. And so there are macroeconomic traders, people that trade on this type of information. To me, it seems quite risky because macro can trade very quickly. We've all seen the number of surprises that come out of macro data for jobs, inflation, interest rates suddenly going up, the price of oil shooting up, price of oil suddenly dropping, copper going up, suddenly dropping, natural gas around the world changing in price too. So, and those effects on macroeconomics. So to me, it's quite a risky thing to try and play on the individual elements, but it gives me peace of mind to know that the market is in the position it's in right now because of things happening in macroeconomics. And I can see that we're moving into a change in macroeconomics, which probably means that there's going to be a change over the next 6 to 12 months in the way that the market behaves around various asset types. Politics are obviously very important to understand, but I wouldn't necessarily make investment decisions purely off of those. An example of where politics is something that might support an investment decision is Canadian Solar is a company that I love that is dirt cheap, based in Canada. And there are a lot of imports of their products into the US. And since Trump was in office, I think it started with Trump in office, there have been tariffs on imports of solar products from Canada into the US, which has impacted Canadian Solar. Now, Canadian Solar, my bottom-up analysis says it's fantastic. The business model, the leadership team, etc., they're all fantastic. The industry is growing fairly quickly. And now there's a political driver there too, because the tariffs have just been removed. They've been announced that they will be removed very soon. And so there's another thing that's going to help this company be successful. And I do rely on technical analysis. It's something that I don't lean on very heavily. When I first became an investor, I wouldn't have said I was an investor, I was more a trader. And technical analysis goes more hand in hand with trading. But it is something that I will look at fairly frequently, although it might not necessarily affect my decision. If something is ticking all the other boxes, I will buy that. However, where it does come into play are my momentum trades. So moving on to the way that I implement my strategy, I would say 80%, maybe even more, of my portfolio is meant to be there for months or years. And there are various reasons for this, right? There's lots of volatility and fluctuations in the market in the short term, and an asset's stock's price, a company's stock price, isn't always correlated to the success and value of that company as a business. And if you try and move between equities in the short term, you're increasing your risk of losing your money. Whereas over the long term, you increase your chance of being successful. Now and again, I will undertake some momentum trades. So a momentum trade is a trade where you try to profit off of the short-term move of an equity or another asset because it has been moving in that direction for a while already with a certain amount of force. So I'll talk about an example of that in a moment. But even in my momentum trades, I will look at the fundamentals and do my business due diligence on a company before undertaking a momentum trade. The execution of the momentum trade is based largely off of technical analysis. So for example, if there is a company that has just had fantastic earnings and has been a successful company for the past 5 years, and there's a breakout pattern to a new 52-week high on massive volume, then there's potentially a momentum trade there. So it's the execution is based on technicals, but it's supported strongly by fundamentals. 10% of the rest of my portfolio is other stuff. These might be hedges, it might be cash. There are times when I like to increase the amount of cash that I have on hand, particularly when there's been a very strong long bull run, because invariably there's some kind of a pullback that gives you opportunities to buy at lower prices. I tend to build positions out in companies that I like, so over time. So if a company, for example, has a bad earnings report and the share price drops 40%, but it looks as though over the next 2 years, that company is going to still be strong. It's going to take them some time to climb back up to where they were before, but it looks as though it's a short-term headwind. Then I might initiate a small position in that company. If the share price continues to go lower, knowing that I've already bought at a level that is cheap, I'm okay with adding more to it. But if it goes in the other direction and it takes off, then I don't mind averaging up if I believe that that company's stock price is still cheap. I don't use leverage, but I realize that this is not completely accurate because I do use leverage on my shorts on indices, which kind of leads into the next point. I hedge sometimes. And when I do hedge, I don't tend to short any stocks. It's just way too risky and the reward is too small. Maximum reward of 100%, maximum risk of infinity because of the way that shorts work. It's safer to short the indices. And if I do so, I might add a little bit of leverage in there or use the leveraged ETFs that Etoro now has, so SPXU, for example. The reason that I hedge infrequently, and I know that this is a contentious point, is that hedges aren't necessarily there to make you money. A hedge is not necessarily a thing that is there to be profitable. It is a thing that is there to reduce the volatility of your portfolio. So you'll hear some people talk about it's there to reduce the loss in your portfolio, but maybe if you sold everything, then it becomes a loss. But more frequently, it's there to help with gut-wrenching drawdowns. Most of the time, though, hedges cost you money. Most of the time, hedge loses money. It's an insurance policy. The same way that you take out insurance on your car or your house or whatever it might be, you're paying a little bit of extra on top of the value of whatever that thing is in case there is some loss of that asset or some damage, for example. But bull markets are 4 times larger than bear markets. They run for 4 times longer than bear markets. And so the probability of you making money out of a hedge is fairly small. So there are times when it feels like it's a good time to put a hedge in, but I will do those very infrequently. And then in terms of my investment expectation, I expect higher returns in the market in the long term, but I'm willing to wear bigger drawdowns in the market in the short term. One word description of these two things is volatility, high volatility. So you aren't going to get superior returns in the stock market without giving something. And volatility is quite often the price that you may have to pay. My lifetime goal. So my lifetime goal as an investor is 20 plus years, although I'd like to think I would live longer than 20 plus years. So 30 or 40 plus years with compound annual growth rate of 25%. Now, when your portfolio is fairly small, so when your portfolio is in the tens of thousands, hundreds of thousands, millions, it's easier to make higher returns than when your portfolio becomes bigger because it's difficult to move your money around. But I still think that this is achievable at the moment. It is a stretch goal, I will admit that. But I think that my CAGR, my compound annual growth rate on Etoro is somewhere around this number at the moment, maybe slightly lower, slightly higher. And my investments outside of Etoro, so I've got a tax wrapper, an ISA it's called in the UK, and a self-invested pension fund in the UK, which can't be on Etoro because of the regulations around those. And those are slightly higher than this too. So I think that this is achievable. It'll be difficult. It'll be a lot of work. And it's an average. So some years you will be up and some years you will be down. Sorry, I've got some notes on the left, so that's why I'm looking over here now and again. All right, so Q2, the quarter that's just gone, the one that's behind us. Headline topics, there was a lot happening, but I think that these are probably the big items. It was a terrible start to the year for equities and several other asset classes. Depending on which market you look at, the least bad version, I think, is it's the worst year for stocks since 1970. I know that there is a bear market definition, which is a loss of more than 20% from the recent high. But that definition was created fairly recently and is arbitrary. I think the behavior of the market tells you more about whether you're in a bear market or not. And I believe that we most certainly are. The S&P 500 had a drawdown of more than 20% at, I think, 2 points through Q2, or maybe across Q1 and Q2. And the NASDAQ 100, that's the NDX, was down over 30% on at least 2 occasions. We also saw record inflation, multi-decade highs being set across the world, and this is still happening this quarter. The UK just published very high numbers, although core inflation does look like it's slowing, but there are other things that are now increasing in price. The dollar is incredibly strong, which creates all kinds of problems. So it's, I think it's set a 21 or 22 year record. So you have to go back to 2001, 2002 to find the dollar as strong as it has been recently. And when the dollar is this strong, the kinds of problems it creates, so it benefits some groups of people. So companies that are exporting things to the US exclusively, then they get paid in dollars and that's translated into their local currency. So they make more money in the local currency, which is great. But it also means that the US starts exporting inflation. And lots of governments also have debt denominated in dollars. So when the dollar is getting stronger, it means that the cost to service the debt, because they're paying their interest payments, for example, in their local currency, the currency becomes weaker. So the debt repayments are going up. So it's very dangerous for the dollar to stay high as it has been for much longer. Growth is slowing, although there have been some surprises. So some countries have slowed by less than thought. The UK had a surprise number in terms of GDP growth for last month. Quite strong growth, actually. But this kind of data can be fairly patchy. We need to see what the trend is. China, I think China began stimulating its economy in Q1, but it took additional measures in Q2. And if China is able to get its ducks in a row and stop scaring off investors and get its economy pumping again, there is a chance that China's economy could pull up the rest of the world quite a lot, in the same way that if the US economy is doing badly, it tends to pull down the rest of the world. So there is a big lag between a government usually, or a central bank, taking actions, macroeconomic actions, and that feeding through to the economy. And that has taken a while to come through, but it looks as though, well, it looked as though there was some growth happening in China, and there are various numbers that are very good, but there are also some numbers that are very bad. Their COVID-0 policy is a big problem, and there are some other risks there that I'll talk about in a moment. Commodities fell during Q2. I think they peaked in Q2, and the fall in price of some commodities has been incredible. So energy companies, so the XLE ETF is a sector-based ETF. It's the energy portion of the US's economy, or companies at least. And that was one of the last few sectors that were actually making a profit in terms of the ETF price through this year. But then during Q2, that ETF lost, I think, half of the profit that it had made through the year. It's still profitable, and the only one standing that's profitable for the year. But there was an enormous drop. And there are things like copper that have dropped enormously in price. And copper tends to be a leading indicator for slowing economic growth because it's used in so many different places. So lots of metal, the prices of lots of metals fell. Lumber, although it's bounced back a little bit. Oil reached $135 and then came down to, I think, $90, $95 in Q2. And because of the shape of the business cycle, usually commodities are usually the last thing to go. And so they signal that you're heading towards the end of the correction, pullback, bear market that you're in. And it doesn't mean that you're near the end, but you're at least, you've begun the journey. Although oil has been stubbornly high. So we have to see what happens there. And also, of course, we're moving into winter, which I'll talk about in a moment. So, the layoffs began through Q2. They might have started in Q1, but they really gained some speed in Q2. Lots of companies during lockdowns, because of coronavirus, started seeing record demand for their various products. I'll pick an example, Amazon. And because of this enormous, unprecedented demand that had been pulled forward, instead of being spread out over several years, they got several years worth of demand in 1 year. They all of a sudden were short on truck drivers, factory workers, etc. And so they hired en masse as fast as they could, and they couldn't even keep up with demand. And I spoke about this in a video that I make every Monday, but the world is now feeling something called the bullwhip effect, where along the supply chain, the elevated demand has meant that everyone in the supply chain has started building inventories because they were so worried that they wouldn't be able to deal with spikes in demand. But now, because demand is falling away, and in some areas very, very fast, they are not drawing down these inventories fast enough. So now they're panicking, but in the other direction. And I'm not sure if everyone saw, but there are some US retailers, for example, where people are saying, I want to return this item. I no longer want it. Please, can you give me a refund? And the companies have so much inventory that they're saying, keep it and I'll give you a refund, just because they don't want to take on more because there are costs involved with these inventories. So I know I've just gone on a long story there about inventories, but that means that because of the enormous oversupply, overhiring, overbuying that companies have undergone, that now they've got too much stuff, but in some cases, they've also got too many people. And so I don't think this trend is going to end anytime soon. And the way that this usually plays out is that as the layoffs go on, it becomes less of a job seekers market and more of a hirers market. And that means that the hirers have more power when it comes to wages. And wage growth is a very sticky form of inflation. So this is an intended effect by the Fed and central banks. All right, on to stats. It has been very, very ugly quarter. Certainly one of the ugliest quarters that I have had on record. So from the 3 months, April to June of 2022, my portfolio is down 28%, which is lower than the other major US indices. Although I would argue that my portfolio composition isn't really suited to comparing to those indices. It's more a combination of an ETF called IWO, which is the growth part of the Russell 2000, and the NASDAQ 100. This is painful for me, even though I mean, I'm an experienced investor. I've been through enormous drawdowns. My portfolio has been down 30% plus in the March 2020 drop, in the 2018 drop, and the 2007, 2008 drop. And despite going through this many times, it sucks, right? I would far rather prefer that it hadn't happened. But I also know that it's temporary. Temporary doesn't necessarily mean short-lived. And this bear market has worn on much longer than the previous two. Maybe just the previous one. 2018 bear market was 4 to 6 months too. So in the short term, I'm losing to the indices, and being a very competitive person, that annoys me quite a lot. But I am a long-term investor. I'm going to be invested in the stock markets for as long as I live, and I hope that is a long, long time. And so if I look back at my portfolio through to March 2015, which is when I started investing in Etoro, my return has dropped significantly, obviously, through the past 12 months. But the return is still significantly higher than the returns of any of these indices. And for me, that is the crux of what I want to keep up. I want to look back over 10 years and my portfolio, maybe there's a huge bear market once again, and my portfolio is down 25, 30%. But when I look backwards, I can see over the past 10 years, my outperformance versus these indices is enormous. And my return has been hundreds of percent still. This is a very simple slide, just because in Q2, just about everything was losing. And I'm exaggerating here. Obviously, there are pockets of green that could be found in various areas of the asset markets. But if I were to generalize, the winners of Q2 were definitely the US dollar. Bond yields have been on a tear through this year. So as interest rates have risen and interest rate expectations have risen, so the US Fed has been hiking more aggressively as they've been faced with more persistent and higher inflation. And bond yields tend to chase the interest rate. The short-term rates are basically the interest rate, and the long-term rates are the short-term yields are the interest rate, and the long-term yields tend to be influenced by the interest rate. So bond prices, conversely, have been doing very, very badly. And I suspect that will reverse somewhere in the next 6 to 12 months. Oil and gas obviously have been doing very well. Oil is off of its highs, so a drop from $135 down to $95 or whatever it is. Is a third of the price has come off the top, but it's stuck around the $90 to $100 mark, which is higher than it was through the past 2 years or so. And natural gas has done very well. And the reason I've got that little dagger there that's supposed to be like an asterisk is because natural gas is a bit of a different beast. Whereas the price of oil tends to be almost universal. And I know that there are different exchanges. The price of oil doesn't vary much across the world, whereas gas can vary quite heavily because those markets are quite localized. So for example, the price of natural gas in the UK has been high, but okay, versus Amsterdam, where it's been absolutely nuts. So natural gas on the whole has risen quite a lot, although that rise has been tempered in the past month or so. And Chinese equities have done quite well. The reason I've got an orange check mark there is because they spent part of Q2 dropping, and then they found a bottom and they bounced pretty strongly and maintained a rally for, I think it was a month and a half. Recently, they've experienced some weakness. But I think overall in Q2, they did better. They were priced more highly than when they entered Q2. Just in terms of everything else. So I don't know what you use to check your various prices of assets, but if you have a tool, you could use Etoro to check this. So if you map out all the sector-based ETFs, so XLE, XLF, XLK, etc., you will see that every single sector-based ETF, so for example, it's finance, technology, energy, consumer discretionary, the value of them is less than going into this year, except for energy, which is higher. So it really is just about everything else. All right, let me do a time check. Oh, I need to speed it up. So in terms of portfolio changes, there haven't been a hell of a lot. I've broken them into things that I've bought and sold, long-term, momentum, and hedges. So for the long term, I've bought Facebook. I'm not sure I believe entirely in Facebook's strategy to build out the metaverse. I think that Apple is better positioned to do something like that. But despite that, the business is still a very strong business in its core business. I know that it's spending a lot of money on its new strategy, but it's still a very strong business. And I believe it's cheaper than it should be. Canadian Solar, I've kind of mentioned before. They are a dirt cheap solar company. They have a subsidiary listing in China. Their profit margins are improving. They've got projects going on around the world. The tariffs in the US have just been lifted. There's a lot going for them. 360-degree Finance is a Chinese company. They're a facilitator of loans. They were a good company before, but when liquidity dries up, when debt and credit dry up, then they have a troubling time. But lots of money is flooding the Chinese market at the moment. And they don't actually own the loans. They are just a facilitator. They have some very cool apps to facilitate the loans between the banks and the people. So I think that they might do very well over the next 2 years or so. And Digital Turbine, which I talk about any chance I can get, is a fantastic company. It is growing into an mobile advertising monopoly, just about. Fantastically run company, great team. I think they might get bought out by someone like Google in the next 2 years or so, but even if they aren't, they're a great business. In terms of momentum trades, so Floor is a company that I picked up and sold off. Momentum trades that don't tend to hold for more than a few weeks. The reason I like this company is because the numbers are fantastic. They're a fairly old company. They're a consulting company that helps energy companies build out capabilities. So for example, if you wanted to build a coal plant, although I'm not sure they do coal plants anymore, this is the company you go to. They imagine Accenture for business or technology consulting. This is the company that does it for energy companies. They just come out of a few consecutive fantastic earnings reports at a few very good quarters. They have a big chunk of a fantastic nuclear company in the US, highly innovative company. It's a private company for now, a company called NewScale, and nuclear is becoming the hot name. So they had lots of things going on in terms of fundamentals, but they also had the technicals there. In terms of hedges, for, I would say, 4 weeks now, maybe 6 weeks, I've had hedges on the S&P 500 and the NASDAQ, just to temper any major volatility. If earnings come in a lot weaker than is expected, then I think that the stock market is due for one more leg down before finding its bottom. And for a while, I was holding long-term bonds because I had thought that everything about interest rates in the US had been baked in. However, inflation kept coming in higher and higher than expected, which meant interest rates were going to go higher and higher, which meant that holding bonds, here I would be banking on the price of bonds, not the yield, wasn't such a good idea. I sold out of ASOS entirely, and I took a bit of flack for that. I think I sold out at an average loss of about 50%. And since I sold out, the stock price went as low as another 50% from there. So I still think it was the right decision. I think that the company is going to have a difficult 2 years because the CEO that grew the company to where it is left. One of the main board members that grew it to where it is left. The war in Ukraine hits ASOS particularly hard. The supply chains are disrupted. Inflation's going through the roof. The margins were thin already. So it's not a company that I want to own for the next 2 years or so. And the others I've already spoken about. I'm going to go through this relatively quickly. I guess you guys can read it. I need to fetch my daughter from school at around 5. The top of the next hour. So I think that through the second half of this year, we will see inflation start to decline in various countries. The core of inflation has already started declining in some areas, but I think that it will stay elevated. Elevated is a fuzzy term, I know, but I don't think it's going to go down to 5 or 4 or 3 or 2% this year. Earnings, I keep on banging on about earnings. The market has priced in a lot of bad stuff, including weaker earnings, but still some earnings growth. And so if earnings are a lot weaker than the market expects, I think that this is one of the few things that can cause the next leg down. Now, so far, the earnings season has been pretty good, but we haven't seen much of the earnings season so far. About half of the companies that have reported earnings have beat on earnings, which is more than I think most people would have thought. But there's still a lot of companies to report, so we will see. I think that we will see lots of recessions. I personally think that there are recessions already, and we'll see more around the world. Some of them will be more long-lived. Unfortunately, I think poorer countries will have longer recessions. I think rate hikes will slow, or it might just be that central banks start setting the expectation of slower rate hikes somewhere in this year. So the market reacts to what central banks say. They believe what they're going to do and what they say, and so they respond, and it becomes a self-fulfilling prophecy, at least in part. I think that we will see some of that this year. A big challenge is going to be energy prices through this year for winter. There's obviously big tensions between Russia and the rest of Europe. The UK is saying they're going to limit exports of natural gas to Europe if they don't have enough for themselves. And so we could see prices start spiking again. And of course, that drives inflation. China is they looked like they were improving their situation, but a few things have appeared that look as though they might cause a crisis. And the government has started responding to these. So 2 examples are, in certain provinces in China, there are runs on the banks. People are trying to get their money out of the banks because the banks have stopped them withdrawing their money as early as April this year. Now people are starting to get panicky. Another is that there are people that are paying mortgages on properties that haven't finished being developed, and they feel that this is unfair. The property developers are having trouble finishing them because of the challenges in the real estate market in China, which is a very large part of their economy. And so now people en masse are saying, I'm not going to pay my mortgage, and that compounds the problem with the property developers. So is there a chance that there'll be a financial crisis? I don't think so. There's a lot of pressure on the government because the largest political event for many years is happening in the second half of the year for China, and I think the president won't want to go into that in a financial crisis or anywhere near a financial crisis. I think that tech, we're probably going to see a bottom, if not having seen a bottom already. That, as I said before, depends on the earnings picture. But through the past 3 or 4 weeks, whilst other areas of the market have continued to drop, technology stocks have been treading water a little bit. Maybe there's been some up and down, but they've been treading water. And quite often the stocks that are affected earliest, at least the high quality businesses that are affected earliest, and tech companies were one of those types of companies, they tend to find their bottom before the rest of the wider market, and even start running up before the rest of the market finds their bottom. And the dollar is likely to weaken. So if the picture becomes a little bit less unknown, because there are lots of unknowns at the moment. Will inflation come down? How much hiking will we need? How long will the war in Ukraine go on? What are energy prices going to be like? So as we move towards the end of the year, a lot of these things will be cemented and we'll know more about them. And I think the picture could even slightly improve. And that means that people will run less to safety in the form of the dollar. All right. What is a quarterly update without a big chart? when people talk about risk, when investors talk about risk, it's a little bit ambiguous, right? They could mean lots of different things. They usually mean risk is volatility. And risk is measured by how volatile certain assets are a lot of the time. I don't believe that's a very good measure of risk. I would say that risk should be thought of as the risk of you losing your money permanently. And so there are a few different ways that you can make that happen. There are a lot of ways that you can make that happen. But one of them is by being a slave to your emotions and by being impatient. And the reason that I've thrown this chart up on screen, so there are 10 or 11 different stocks there. I just picked a few different companies that are in my portfolio. I don't think AMD is in my portfolio, but it usually is a part of my portfolio. And you can see that the S&P 500 is also in there too. It's maybe a bit tricky to see, but you can see that over the past 6 or 7 years, the S&P 500 has given a fantastic return of 86%. So you would have nearly doubled your money if you'd bought and held the S&P 500, despite the enormous drop that we've seen over the past 6 months. However, if you had done your homework, and that's important, you have to do your homework, you need to spend the time looking for these companies and understanding them, you would have had to write out a lot of volatility. And you can see that in the various colored lines on the chart. And some of those companies haven't done very well. They've underperformed the S&P 500. So I've got Disney's minus 8% for the past 5 years, although I think it's steel right now. Alibaba's down, is only up 22, 23%. So you will have a few underperformers. But the whole name of this game is you need to win more than you lose. And you just do that a little bit over time and it compounds. And so the vast bulk of these companies have dropped enormously from their highs. AMD was at one point up 5,400% over the past 5 or 6 years, a 54 bagger, 54 times your money if you'd managed to sell the top. And it's dropped to a 30 bagger. But even then, despite that enormous drop, if you'd held it through all of that, you would be smashing the S&P 500. And AMD is not going to go anywhere. It's not a company that's going to disappear. There's no risk of that company. Well, there's always a small risk, but there's very little risk that AMD is going to go anywhere. They're a fantastic company. They're doing so incredibly well. And the likelihood is that they continue to do well. So when the world changes and the conditions change, it's very likely that AMD will continue to outperform. I know that you can't entirely base your decision on history, and so you need to understand the company and the environment. But what I'm trying to illustrate is that volatility is painful, but if you know what you own and you have some experience in wearing volatility, you can do very, very well. And one of the riskiest things you can do is be impatient and hop around trying to invest in different assets, which I feel can be a lot more risky. All right, finally, you've listened to me for a long time, so you've made it to the closing remarks. Pessimism is always at a peak during the depths of a bear market. It doesn't make sense. It's the opposite of what it should be, right? You might have seen Google increasing in price over the past 2 years. Tesla increased in price, Apple increasing in price. Name your favorite company. And we're worried about buying in because you knew that it was expensive and you didn't want to get in. You were waiting for the right price at the right time to come about so that you could buy in. And now in front of us, we see lots of companies whose share prices are enormously discounted. Huge discounts to the all-time highs. A lot of them didn't deserve those all-time highs, but they are still much cheaper than they should be and will probably be years from now. And the opportunity is right in front of us. But pessimism peaks at the bottom of the bear market. And so people stay out and they wait for the recovery. And every bear market rally, they stay out because the past few bear market rallies that we've seen saw the bottom even lower than going into that bear market, that bear market rally. And so they miss the actual rebound from the bottom. And then when it's rising, they're always worried that it's a bear market rally. And then when it's gone on for long enough, they don't want to get in because now it's too expensive and surely the market's going to correct. And so people get stuck out of the market, missing the fantastic gains that they could have. You just need to go back through history. I know that our situation at the moment is not like the situations during any of the last major crashes. But all of those times had big problems of their own, and ultimately humanity prevails. And the people that are calm and do their homework, some of them will make fortunes by seizing the opportunity that we have in front of us now. There might be some pain in the short term. I mean, there might be another leg lower, earnings come in awfully and the market goes a little bit lower, but even at current prices, there are lots of companies that are much cheaper than they will be 2, 3, 5, 10 years from now. All right. And just a few stats there on the right-hand side to put you ease of mind. So 78% of the last 92 years were bull market years. The average loss in a bear market is 36% down, but the average gain in a bull market is 114%. If you'd bought into the NASDAQ 100, and it would have been very difficult to do 20 years ago after the dot-com boom and bust, you would have made 11.5 times your money today. If you couldn't deal with that volatility, you could have chosen the S&P 500 and you would have made 3 times your money. All right. We finally made it all the way through and we have a few minutes for questions.